You go? No, okay, I'll go fine. So basically, to start off with, this is essentially going to be a club slash kind of course for trading, and I know we harp on a lot about making money, and a lot of people, the first question people say to us is, where's the proof, what money we actually made? So this is, when it comes, is a graph of Vane's equity curve from last year. So it's basically his starting capital, £500, and just a graph of. It's just okay. Thanks. Nice. Okay.
So there's the starting point. Last year, this is a total of I think 72 trades taken. So as you can see, this is a quite healthy equity curve. So growth, they do have small retracements.
So when it goes down, it essentially means you've lost a trade, and when it goes up, you've won a trade.
That's all it means. So
it's a healthy curve. So money's being made. So yeah.
So these are the different types of markets. So we have stocks, which is usually by like companies, so Tesco have a stock. Foreign exchange, which we'll be mostly focused on. So it's the currency pairs, so the Great British Pound. Thanks for turning off, fellas.
Thanks for turning off the time, guys. Appreciate it.
CFDs, this is basically indexes, like some of you might have heard of the FTSE. Futures, which are contracts which expire. Same with options. Spread betting, which we can actually take advantage of in the UK, so which is tax-free. So yeah.
So okay. So this is Harold Gartley. This is the guy who it's named after.
He's the big boy.
He was a trader from the 20th century.
Benches.
He was a businessman, and he was like also a part of the original birth of the stock market. He wrote a book called Profits of the Stock Market, and along with it, he also had a course accompanied with it, which was $1,500, which at the time was worth 2 Ford cars, and it still sold thousands. So he was pretty mad. And this is the pan, what he came up with. These 2 triangles here, that's called the Gartley pan.
Let me demonstrate it quickly. It's good. I just want to use the pen, to be honest with you. Right, so it first starts with move down in the market, retracement up, comes down and up, and then basically that at this level, a sell signal is produced, and as you can see, profits hit here. Yeah,
why have you just drawn the lines that are already there?
Because you may have some confusion between these lines. These are the Fibonacci ratios, which we'll be touching on in the
No,
future.
but I can see the difference, the different lines.
Okay.
So no, but okay.
Moving on.
Wait, so is that from the highest point to the lowest point? Is that?
Yeah, we'll
Yes.
look at it more
This
in
is just
depth
showing you what
later.
it is.
But
We'll
this
go
is
through it.
basically it starts with an impulse move, so quick move down. That's all.
Without? No.
So, how familiar is everyone in here with how prices work? Who does economics in here for a start?
I did.
Okay, so basically, prices move when people buy and sell. So it's a pretty basic concept. When there's more demand in the market than supply, the price will go up. More people want to buy, so sellers take advantage of this and push the price up. And then the other way around, when there's less demand, they have to put prices down to retain their sales. So that's just why price moves up and down, just as a combination of people buying and selling. It's basically what it is. And so there's 2 types of analysis that you do in trading. One's called fundamental analysis, and one's called technical analysis. We're going to be focusing more on technical analysis with this, but fundamental is still pretty important. Fundamental is basically like looking at the news and using like economic knowledge and stuff like that to try and predict which way the market's going to move. It's mainly involved more with long-term trading and investing. So we will be doing bits of that, but what we'll mainly be doing is technical, which Ian will talk about.
So technical analysis, basically we look at supply and demand patterns. So it's a pretty basic concept. Let me get the pen. As you can see, price is moving up here. This is because people are buying up the price from this level, which they consider cheap. At this level, the sellers step in. The price moves below this line here, So this basically just means that the sellers have taken over and that people are willing to sell the price down. As you can see, the price moves down. Then this continues for ages, as you can see in this chart. And we can actually take advantage of some of these moves as traders, and this is where we profit.
So, so this is the standard price chart. Yeah. What was that? So this is the standard price chart. This is what we're going to be working with. So this axis is price, and this axis is time. I don't know if you can tell, but you can see the months of the 2016 started there, April, June, July. So do you want to go through the quote price and base price?
So as you can see, this is Great British Pound versus the US dollar. So this means the Great British Pound is the base price, and it's quoting the US dollar. So for every 1 Great British Pound,
you get
it is
$1.23. That's just
all it
basically what it means. You'll probably be more familiar with this if anyone's done this before. This is the same thing but in lines. So this is called a line chart. But what we're going to be dealing more with is it's called candles.
Candles represent more information than the line, because the line is just the middle of each candle basically. So when like a time frame opens, so say it's the opening of the morning, this is the bottom of the candle. So now price will move up and down throughout this time period, and that creates these ranges. So this is the lowest price it moves within, say, 1 hour, and this is the highest. And then when it closes, it makes this. So if it opens here and it goes down, it will be a red candle, and if it does the opposite, it will be a green candle.
Yeah.
So if you see a succession of green candles like here, this is known as a trend because the market is obviously trending. Do you want to go to the next slide?
So
can anyone spot a minor trend
the
within
biggest
this?
trend in this? Do you want to come draw it up? Do you want to come up and draw it? Do you want to come up and draw it?
We're not like level 4.
Do your one.
Start the basics.
Just literally draw it on that. Just circle it.
Yeah,
Yeah,
that's the
nice.
trend.
So that's the main trend there.
Okay, and this hold on, this is called a bullish trend. When the market moves up, the bulls are in control. It's called the bull, right? So on the next one.
So yeah, do you want to go over the trend stuff?
Sure, buddy, sure. So can anyone spot a bearish trend, which is the opposite of the bull trend?
Right.
Yeah.
Yeah, so that's
So that's the bearish
I was
trend.
just wiping something off the
I
screen.
tried to find like easy charts.
So yeah, so this is so when it goes down, bearish. When it goes up, bullish.
That's what it basically means.
I think it's sure.
So the way you make money in trading is essentially by the concept of selling something for a higher price than you buy it at. Like that's the only way it's done. It's literally as simple as that. That's all you do. So you can do that by two ways. You can either buy something and then sell it later at a higher price. Revolutionary.
Oh
idea.
yeah.
That's your profit. And another way you can do is you can sell something first and then buy back later, which
For a
may
lower
seem
price.
counterintuitive to some people, but this is also a viable thing you can do.
How can you sell it if you don't have it?
So
You
basically-
sell imaginary.
The way this works is things like CFDs, okay, a contract for difference. It was one of the things we said at the
Yeah.
start. It's essentially a contract for difference is a derivative of the asset. So say if you have a CFD of gold, when you buy and sell, you're not actually buying and selling actual gold. You're buying a contract representing gold. So you can sell someone a gold contract, but which is fine because you don't actually have the gold, and then you can buy that contract back at a later price.
Yeah.
So it's not the actual asset that's moving; it's the representation of it as a contract. Does that make sense?
If you
Does that
had
make
some,
sense?
if you had some gold, then you sold it and then bought it back, it would be the same price, wouldn't it? But it's just the charts that are different.
No, say you bought some gold. Bought some gold, and then it went up in value, and you sold it. You'd obviously make the difference.
Yeah, but does that translate into the actual price of gold itself?
Yeah.
Yeah.
This
So
is
that's
exactly. This is when.
So this chart is the price of the Singaporean dollar.
But let's
compared
just
to
say this
euro.
was gold. This would be the movement of the gold price throughout
So you
this
buy
time
it
period.
here, you buy the price here, you wait a bit, you sell it when the price gets to here. That's your profit. For
Yeah, no, I understand that, but like you said it was something through like the contract of it not
Contract
actually being
difference.
gold.
Yeah, because when you buy gold on the market, they don't actually ship you gold,
yeah,
right?
yeah.
They don't give you a physical piece of gold.
You
And
buy
then
the
you don't,
contract.
and then you don't like ship it back to them and say, I don't want it anymore.
You can have it now.
So that's
Could you,
long,
if you
and
wanted
then-
it, could you get it?
No,
people-
then you just buy gold off eBay or something.
Oh.
Yeah.
Yeah, you're investing in the
So
gold market. rather
Yeah.
than
Would like
actual
people
gold.
change if they had a bit of gold on sale? Would they change the prices in accordance to that, like every like?
Yeah,
minute?
it would be a good idea to actually, if you have some gold, to follow this market to know when to sell it, but on a higher time frame. That's true. You would be.
So that was going long. Then this is going short, which we've talked about, which is when you sell it, wait for a bit, then buy back at a lower price, and that difference is your profit. So yeah, so risk management is probably one of the biggest parts of trading, which people don't take into consideration when they start. A lot of people, when you mention trading to them, the first thing they say is, "Oh, you'll lose all your money in the stock market." That's what happens to everyone. Well, realistically, if you manage your risk, that doesn't happen. That's just for people who get cocky and then just blow out all their money in a few trades. So risk management is key to trading. So on each trade, you shouldn't really be risking more than 1 to 2% of your starting amount. So if your starting capital is say £500, you shouldn't really be risking more than £5-10 in each trade. So that means the maximum you can lose on that trade is £5-10. So if you lose a couple trades, you're down to from 500, say about 480. You can stop it. You can cancel out there instead of just blowing all your money.
So 95% of traders fail. This is basically mainly because of the risk management and probably psychology, which is another thing that we will talk about like in another time. So, but when you find most strategies out there actually work, it's just that, like I said, risk management and psychology. So that's why you have to be